In the financial world, JPMorgan, which we will be looking at today, could win an Oscar for its financial performance. It is that perfect. So why did I short this company's stock? Before we move on to the chart, we will look at the company's fundamental indicators. The stock price is currently around $360. The company's market capitalization is approaching 1 trillion. The PE ratio is 15.5, which means that an investor pays a little over $15 for every dollar of annual earnings per share. But for a bank, it is much more interesting to look at the book value. Book value is the difference between all of a bank's assets and the sum of all its liabilities. The price-to-book ratio for JPMorgan is currently about 2.7. This means that you are paying about the price of 3 liters for 1 liter of milk. You must really love milk. In other words, you definitely can't call JPMorgan cheap today. On the other hand, well, there is a reason to pay such a premium. The second quarter was a record breaker in terms of profit, 21 billion. True, 4.5 billion, well, a little less, of the net profit came primarily from operations with Visa shares. But even without them, JPMorgan earned almost $17 billion and showed a 23% return on equity. For a bank, this is a very high figure. Moreover, almost everything is growing. Loans up 10%, deposits up 7%, investment banking fees up 30%, trading revenues up 35%, and trading itself is up 86%. Assets under the company's management already exceed $5 trillion. At the same time, the balance sheet remains very strong. The bank's capital to risk-weighted assets ratio is 14.1%, compared to the regulator's requirement of 11.5%. This means the bank has a safety margin of 2.6 percentage points. JPMorgan is increasing dividends and launching a $50 billion share buyback program. Therefore, the fundamental problem for JPMorgan right now is not the quality of its business. The problem lies elsewhere, and it is paradoxical. JPMorgan is too good and is currently trading at effectively its maximum. That is, to continue growing, the company effectively has to maintain an ideal growth trajectory for financial indicators that are already too good. And this requires an ideal scenario. How well it will be able to maintain that, I do not know. And now let's look at the chart. What technical analysis tells us. As in the previous review, we will first look at the higher time frames, monthly candles, then weekly, then daily, and draw conclusions. Before us are the monthly candles of the company's stock. The price is currently $362. What would I pay attention to? Well, first of all, to the fact that the last touch of the 50-month moving average was approximately in March 2023, where the cursor is. Secondly, the deep correction began in October 2021 and ended around October 2022. That is, it lasted a whole year and amounted to, about 41.5%. After that, the stock only grew without any significant corrections and rose to its maximum by 261%, that is, 3.6 times. I would also like to draw attention to this point. Let's stretch the chart and look at it from a closer distance. Look here. Here is one zone of highs and here is the second zone of highs. They are naturally rising, but the RSI highs that correspond to them are falling. If you don't see this clearly, let's expand the RSI chart. You can see it quite clearly. I'll even remove these circles now. You can see that the highs are falling. If we see an RSI high somewhere in this zone that is below these levels, and at the same time we also see a bearish engulfing pattern on the monthly candles, then it is quite possible to consider a short position on this stock. Now let's look at a few more points. Note that the stock has moved quite far away from the 50-month moving average and hasn't even approached it for a very long time. Again, all this is against the backdrop of a potential divergence. This suggests that if you were to take a short position somewhere here, which I wouldn't recommend doing because there are no clear signals yet, it's unlikely the stock will double in price again. Therefore, if you take a short position with 1x leverage, you could say that your risks would be, well, let's put it this way, not minimal, but it's unlikely you'll get liquidated. In other words, it's unlikely that the stock will double from current levels. I emphasize, this is not an artificial intelligence company. This is not a venture capital firm. This is already a fairly old bank. Moving on, let's switch to weekly candles after first clearing all the drawings. What do we see here? And here we see another pattern. Here is one RSI high, here is another RSI high, and here is an even lower RSI high. And each of them corresponds to a higher stock price value. So you could say this is also a double divergence, just on the scale of the last 2 years. I don't know how seriously this should be taken, but at the end of this video, I will show something that made me take a short position right now. It's very small, insignificant, but you definitely shouldn't be buying anything here. I mean, I wouldn't say that you can open a short position based solely on this chart. The growth could continue here. The market can remain irrational for too long. But again, we are quite far from the 50-week moving average, and we are quite far from the 50-month moving average. And this suggests that, mathematically speaking, the value will sooner or later tend to return to its mean. Which means the chances of it dropping to the area of, say, $315 on the weekly candles, or, for example, to the area of somewhere around $250, I'm even being conservative here, on the monthly candles. The chances of that are high. Now let's look at the daily candles. On the daily candles, the situation is much more interesting. Notice that the stock price is rising. We'll draw a line, and we can see that the price highs are rising roughly along this line. And what do we see with the RSI? On the RSI, we can see that this line is definitely pointing downwards if you draw it along the peaks of the indicator. This is a very clear divergence, already a double or maybe triple, it's hard to count. And at the same time, pay attention to an important point. Here, did our candle from August 13th form or not? No, it didn't form. The candle from August 14th did that. A bearish engulfing pattern. So on the daily candles, the trend has already reversed, there is already a divergence, and its minimum target is for the RSI indicator to enter the 50 level zone, but we haven't even approached it yet. So from this point of view, you could try a short position with a stop loss above the daily candle of August 13th, or without a stop loss, although I wouldn't recommend doing that. At the very least, this is a completely bearish situation, and all that's left for us is to choose the target for this decline. It is quite obvious that the target for the decline is the 50-day moving average, and that is the minimum target. What other target could there be? Well, probably a technical level associated with this high here. Look, a very deep pullback started from it, and we couldn't break through it for a long time. Accordingly, it is now acting as a key support level. And accordingly, it acts as a magnet level, so during the decline, we could reach somewhere in this area. And the 100-day moving average is also pointing right here. And this is the minimum target. That is, the current $362 could easily turn into a 7.5% drop from current price levels just on the daily candles. I already said where to place the stop. And now for the bonus I mentioned. Well, the first bonus is the Quant Fury app or platform where we are doing our analysis and where I open my trades. There are absolutely zero commissions for any actions, pure trading, and everything depends on your analytical skills and your risk control. The second point is 2 charts on TradingView with my own indicators. And the key indicator that we periodically look at together on YouTube is right here at the bottom. This is the overbought oversold indicator, and it indicates that the stock is in a zone of strong overbought conditions on the weekly time frame. At the same time, there is a quite interesting situation on the monthly time frame as well. Pay attention, right here there was a strong overbought condition. What happened to the stock? Yes, it fell for 3 months. We can even estimate how much it fell. From this point, it fell here by 17%. But now we see a higher high. That is, this high is accompanied by a much lower high on the indicator. And as soon as, again, we see either just a red candle here after the high is updated, or a break in this indicator downwards, it will signal that the stock is ready to move towards these 2 mathematical targets. Again, this is my own indicator, and these levels are significantly lower than on the daily candles. $220, and then approximately $195, $170. Therefore, you shouldn't buy this stock if you are planning to invest in this bank. And in principle, you could consider a short position. I already told you where to place the stop. Subscribe to the channel, leave your comments. See you next time.